all. I welcome you to the lecture series of the subject Financial Accounting for the academic year 2020-21. Today, friends, we are going to start discussion over the subject Financial Accounting for the semester 1. We will start our lecture from the unit 1, which is entitled as Basics of Accounting. Myself, Dr. Supriya Saugule. I work as a assistant professor in DRK College of Commerce, Kolhapur. So, from onwards, we are going to start a discussion with notes, PPTs, lectures on online mode for the subject Financial Accounting. So, as I told you, today we are going to start discussion from Unit 1. As I have mentioned that Unit 1 is entitled as Basics of Accounting. The contents of Unit 1 are basic accounting concepts and conventions, accounting process, accounting standards, its needs and procedure, and concept of IFRS. So these are the concepts which are going to be discussed and the contents which are included in your unit 1 for the subject Financial Accounting. Now before starting our lecture for the subject Financial Accounting, let us have some glimpses for the accounting background. As I have mentioned, accounting is the process of recording financial transactions pertaining to a business. The accounting process includes summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. Accounting is commonly referred to as the language of business. Just as language is a medium of conveying thoughts of each other, language is a means of communication, and accounting is also expected to communicate matters relating to economic or financial transactions either of an individual or of a business, small or big. Accounting is also considered as art of measuring, communicating, and interpreting financial activity. The underlying purpose of accounting is to provide financial information about economic activity. Classifying is the systematic analysis of the recorded data, which is done in the accounting. All cash transactions, for example, all cash transactions are grouped under the head of cash account or cash book. So we can get the classes separately for each transaction and we can get systematic analysis. Accounting is an age of rapid development. Much of what is accepted as accounting today would not have been recognized as such 50 years back. And in 50 years to come, accounting of today will be of little use. That is, old order changes giving place to new. Changing environment has not only extended the boundaries of accounting but has created a problem in defining the scope of the subject. As such, accounting is moving rapidly now towards a consideration of social welfare objective. In the past, the interest of shareholders investors, creditors, and managers have exerted a dominating influence on the development of accounting practices. Accounting is so pervasive nowadays that it is useful in all type of organizations and not limited only to business organization. Every organization, it may be hospital, school, government, etc., is required to maintain its accounts as it has dealings in money or money's worth. As we have seen that accounting is a language of business, is expected to communicate matters relating to economic or financial transactions either of an individual or of a small business or big business. Accounting serves as a permanent record of business dealings and it can be produced as evidence whenever and wherever required. So, therefore, this was the brief about accounting. Now, let us understand some of the core objectives or basic objectives of accounting. Objectives of accounting in any business are systematically recording transactions, sorting and analyzing them, preparing financial statement, assessing the financial position and aid in decision making with financial data and information about the business. The main objective of accounting is to ascertain the result of financial transaction of the business concern. Now briefly look at the objectives of accounting. The basic objective of accounting is to supply the necessary information to the users and analysis for taking decisions. And other objectives like accounting keeps a systematic and permanent record of all transactions. To keep record of income and expenses in such a manner that net results of a business can be quickly known for any period. This is the another objective. The third objective of accounting is to keep record of assets and liabilities so that the financial position of the business on any day can be ascertained. The next objective is to provide necessary information about efficiency of the management in respect of utilization of scarce resources. Also, evaluation of earning capacity of the firm by supplying statement of financial position, that is balance sheet, and a statement of periodical earning, that is profit and loss account, together with a statement of financial activities to the various interested parties. Next objectives are to keep control over expenses and to minimize expenses. Also, accounting aims at providing information to meet various legal requirements for income tax return or sales tax. To help in decision making in respect of acquisition or use of preservation of scarce resources, accounting serves an important role. And to disclose whether the actual performance is deviating from the planned performance or information that is going to be conveyed to the management to take remedial measure. So these are the objectives of accounting. This can be also treated as advantages of accounting. Accounting facilitates a comparative study by preparing comparative statements or common size statement. It throws light on efficiency of management. The resources available are being used efficiently and economically or otherwise is going to be find out by the accounting. Now let us know about branches of accounting. In order to satisfy needs of different people interested in the accounting information, different branches of accounting have been developed. Those are financial accounting, management accounting, cost accounting, and social accounting. Financial accounting is recording of the financial transactions to find out manufacturing or trading results at the end of the year and ascertaining the financial position on the last day of the year or whenever felt necessary. The financial accounting is such a branch where only financial transactions are recorded, analyzed, and interpreted. Also, financial accounting aims at analysis of and interpretation of financial statements so that management can understand the significance of figures and draw meaningful conclusions. The second branch of accounting is management accounting. Management accounting is meant for management and not for outsiders. It helps the management to perform all its functions like planning, organizing, staffing, directing, and controlling. The basic objective of the management accounting is to furnish the accounting and other relevant information to the management whenever required in such a way that it will help the management in formulating policies and taking decisions. Another branch of accounting is cost accounting. Cost accounting is the branch where account deals with classification, recording, allocation, summarization, and reporting of current and prospective cost. Cost accounting comprises of collection of cost data, preparation of cost records, ascertainment of cost, and use of cost data for cost control or decision making related to price. And the last one is social accounting, which is also called as social responsibility accounting. Social accounting is also referred as the measurement and reporting, internal and external, of information concerning the impact of entity and its activities on society. Social accounting is a system assessment of and reporting on those parts of company's activities that have a social impact. Social responsibility accounting therefore describes the impact of corporate decisions on environmental pollution, the consumption of non-renewable resources, and ecological factors on the rights of individuals and groups, on the maintenance of public services, on public safety, on health and education, and many such other social concerns. So, these were the branches of accounting. Now, next term is accounting principles. Accounting principles are accepted as such if they are objectives, usable in practical situations, reliable, feasible, and comprehensible to those with a basic knowledge of finance. Accounting principles involves both accounting concepts and accounting conventions. So let us see some brief explanation towards accounting concept and convention. The first accounting concept is business entity concept. This concept is about a business and its owner should be treated separately as far as their financial transactions are concerned. This means that the concept implies to the business unit that business unit is separate and different from person who are owners of the business, and a limited company should be treated as artificial person which is created by law, hence it is a separate legal entity from its owners, that is shareholders. The next concept is money measurement concept. This concept is about that only business transactions that can be expressed in terms of money are recorded in accounting, though records of other types of transaction may be kept separately. That means which are expressed in the monetary term, those are only considered here for the purpose of recording. If the results of operation of a business entity are to be properly accounted for, they need to be expressed and recorded in common units of measurement. Next concept is dual aspect concept. This is the basic concept of accounting. According to this concept, every business transaction has dual, that is twofold effect. For that is, every debit has its corresponding credit. The entire double entry system is based on this concept. For every credit, there is always corresponding debit is made. The recording of a transaction is completed only with this dual aspect concept. Next is going concern concept. According to this concept, in accounting, a business is expected to continue for a fairly long time and carry out its commitments and obligations. This assumes that the business will not be forced to stop functioning and liquidate its asset at fire sale prices. As a result of this concept, investments are made in fixed asset as well as in the current assets, and the fixed assets are valued at not at market price or realizable price, but they are valued on going concern basis, that is costless depreciation. The next concept is cost concept. This concept is closely related to going concern concept. The fixed asset of a business are recorded on the basis of their original cost in the first year accounting. Subsequently, these assets are recorded minus depreciation. No rise or fall in the market price is taken into account. The concept applies only to fixed asset. Next concept is accounting year concept. According to this concept, each business chooses a specific time period to complete a cycle of accounting process. For example, monthly, quarterly, or annually. We have seen that the life of business is very long, indefinite, and one cannot wait to find out profit or loss from the business till its shutters are finally pulled down. It is also not a wise policy. Therefore, it becomes necessary to divide the life of business into appropriate segments for studying the result of operations. So, accounting year is about choosing a specific time period to disclose the accounting information. This segment is called as accounting period, which is generally a year. This enables the management to take necessary steps and make progress. Matching concept. This concept is about the principle which dictates that for every entry of revenue recorded in a given accounting period, an equal expense entry has to be recorded for correctly calculating profit or loss in a given period. And the last one is realization concept. According to realization concept, profit is recognized only when it is earned. An advance or fee paid is not considered a profit until the goods or services have been delivered to the buyer. The concept answers the question as to when and how revenue is recognized in the business. Sales revenue is considered as recognized when sales are effected during the accounting period, irrespective of the fact whether cash is received or not. In this case, the realization concept revolves around determination of the point of time when revenue are earned. According to this basis, revenue is considered as recognized or realized only when cash is collected from sales. Now, let us know about accounting conventions. Conventions are based on practicability. The term conventions include those customs or traditions which guide accountant while preparing the accounting statements. There is no clear-cut distinction between concepts and conventions. As such, some of the conventions are treated as concepts by some authorities. There are four important conventions. First is conservatism. This convention is by which when two values of a transaction are available, the lower value transaction is recorded. By this convention, profit should never be overestimated and there should always be a provision for losses. On account of past bad experience, the accountant agreed to follow the rule anticipate no profit but provide for all possible losses while recording business transaction. This convention has become target of serious criticism on the ground that it goes against the convention of full disclosure. Next is consistency convention. According to this convention, accounting reports should fully and fairly disclose the information they intend to represent. It prescribes the use of same accounting principle from one period of an accounting cycle to the next so that the same standards are applied to calculate profit or loss. Next convention is materiality. Materiality refers to what is significant and what is insignificant. Means that all material facts should be recorded in accounting. Accountant should record important data and leave out insignificant information. And the last convention is full disclosure. According to this convention, accounting reports should fully and fairly disclose the information they intend to represent. They should be honestly prepared and should disclose information which is of material interest to the proprietors present and potential creditors and investors. It entails the revelation of all information, both favorable and detrimental to a business enterprise, and which are of material value to creditors and debtors. So, with this note, today we are ending up our session. Today we have discussed introduction to accounting, brief summary about accounting, meaning, objectives, and advantages of accounting, objectives in detail, and branches of accounting, as well as detailed discussion on accounting concepts and conventions. Thank you, friends. If you have any difficulty, 2 to 3 times repeatedly listen this lecture. If still you have any query or question, you can post on our WhatsApp group. Thank you and have a nice day ahead.